Grand finale welcome to all of our attendees and new members that have come on board on day 1, 2, and now 3. Hopefully many of you have been making some noise and sharing the insights that we've gained from leading speakers with a cycles focus. Remember, it's been a live event for 3 days with 6 speakers discussing many different market themes. And that has certainly helped build another record attendance, significantly more from past events. Now, a big drum roll for our day 3 speaker lineup. It is, as you can see there in the video, Peter Eliades, who will be talking about Hurst cycles theories, projecting future prices and the current US market. And then following will be FSC board member Bill Sarubbi on US stocks, real estate, and the economy, building on themes that were shared early this year as part of the original board market update. A reminder on the value proposition of becoming a member. There are many, but just to summarize, it's the regular content in terms of webinars, our Cycles magazine, which has more than a 50-year track record from the days of Dewey up until now, fellowship of scholars, scientists, and non-professional research in this area, which we're continuing to develop as part of the mission, and then an industry award recognized tool, the Cycles app, which can help decode cycles, both market and non-market related. I did want to include a big shout out to our latest Cycles magazine. If you do not have the latest edition, please make sure you do. It's jam-packed with lots of really useful research and insights. I've included the contents there on the right, so you can just see Benner cycles, 956-year grid, the paradigm shift by the Kondratiev wave, and the genesis and predictive power of breaking the code of history. And then finally, on the geological side, Californian earthquake cycles. So you've got a real mix there of both market and nature cycles. And then, of course, most importantly, as a nonprofit organization, we always like to welcome further support, both in terms of monetary donations, but also in terms of just greater good support towards raising awareness, contribution of ideas, and time as a community. After all, that is why we are all here today, to connect with each other as like-minded professionals with the focus on cycles. And so we really want to continue with that stronger together focus. And a reminder just on the logistical side to share your questions. We want to encourage as many questions as possible. So please send them through to the Zoom Q&A box, and I'll respond to you on each one, just let you know that it's noted, and to ensure that you get your answers, your questions answered. And just to warm up that setup, I'm going to ask you, as I did yesterday, what are your key insights from day 2 of the Financial Cycles Summit, so the one prior, on the 2 presentations, the fireside interview with FSC board member Bradley Rodder on crypto, quantum computing, and where do we go from here, and then presentation 2 by FSC board member Jake Bernstein, interest rates, currency, long-term cycles. I'll let that roll. Spencer is saying unwinnable war in cyberspace. That was one of the talking points, and I'll let that conversation continue. Okay, let's proceed with our opening guest speaker presentation, Peter Eliades, Hurst cycles theories projecting futures prices and the current US market. Peter, as a brief intro, you began your career as a stockbroker, appearing as a market analyst on FNN. From 1975 to 2011, Stock Market Cycles newsletter predicted amazing, accurate, and stock market highs and lows. Eliades has regularly appeared on Business World, CNBC, Wall Street Week, and Nightly Business Report. Has been featured in Barron's, the Wall Street Journal, Forbes, and Futures magazine. It is a great honor to have you here on behalf of the Foundation Study of Cycles, and a great interview that I encourage all of our members to watch with Lars von Thienen, where there was a deep discussion on both markets and your general journey in the world of cycles. Over to you, Peter.
Thanks a lot. I appreciate that, Ron. This is going to be a lot of fun. At least for me, it'll be fun. I hope it's fun for everyone else, and I hope there's something there for people to learn too. I'm going to start out by doing the same type of thing I did with Lars, because the software that I finally had developed after, I can't tell you, I mean, literally decades of attempting to put together a software that would be able to use the Hurst theory of cycle analysis, not from his original book, The Profit Magic of Stock Transaction Timing. That's what got me started in the whole cycles world, as it would be. And a quick story about that. This is back in, I'm going to have to guess now, but I'm guessing it was in the very late 60s, early 70s. That's around the time the Hurst book came out. And I was at a friend's house in California, a beach house. He invited me down to participate in a beautiful California weekend. And on his coffee table was that very book, The Profit Magic of Stock Transaction Timing. I looked at it, and because I was just getting interested in the stock market at the time, I asked him if I could borrow the book. And he said, of course you can. And again, that was his great mistake, because when they tell you never lend a book because you never get it back, that's the way it worked out. I still have that book behind me in my little bookcase here, Profit Magic of Stock Transaction Timing. It's had a little wear and tear over the years. I was in the music business. I graduated law school way back when, passed my Massachusetts bar. I immediately went to New York City and started performing in nightclubs, singing and playing the piano. And I loved music, was always my first love. So I did that for 3 or 4 years in New York City, played every piano bar in New York City. At that time, I moved to LA because I figured they wanted to make a big star out of me there. So I went to Hollywood, lived in the Hollywood area from that point on. That's when I became interested in the stock market. It was 1968. There was a mutual fund called New Earth that was up over 300% for the year in December of 68. This was a mutual fund up over 300%. I immediately made an investment in it, my first investment ever in the stock market, and proceeded to lose about 20% in the next 3 or 4 weeks, maybe 2 months. And I said, well, there's something wrong here. So despite my great liberal arts education, I went undergraduate to Harvard and Boston University Law School. I didn't know the first thing about the stock market, but I made my mind up at that time that I was going to learn. So I went to the library in Hollywood, California, of all places, and read everything I could on the stock market. And that piqued my interest. The more I read, the more I became interested, not on the fundamental side of the market, but on the technical side. My background, my major at Harvard was physical sciences. So my background was in the kind of the technical, what would be considered the technical side of the market. And so I became fascinated. And especially after I read the Hurst book, I said, oh my God. One of the things Hurst said in his book was news has nothing to do with the market. I'm paraphrasing. But I had that feeling intuitively when I first started following the market that there was no correlation whatsoever to news and the stock market, especially with trends longer than a day or two. Sure, there can be a reaction to some kind of Federal Reserve news or whatever. But if you look over the weeks and months rather than the day, you're going to see that things ended up doing what they would have done anyway. So I became fascinated. There were at the time Mansfield charts. I went out, ordered Mansfield charts, and I spent the next 6 months to a year sitting down with a bright light and a pencil counting 1, 2, 3, 4, 5, 6, 7, 8, 9. There's a bottom there. 1, 2, 3, 4, 5. I started counting cycles, became fascinated by it. And I'm probably spending too much time giving you my background, but I think it's interesting. And it's the way some of you, hopefully younger ones, might get into it. I became completely fascinated by cycles in the market. And at the time I was working still as an entertainer, and I became interested when I became interested in the market, I started calling a sponsor of the first financial station in the country, a KWHY in Los Angeles. And I started calling a broker there and asking for data, ups and downs, stocks, advances, declines for the day, whatever, closing prices, highs and lows. And it was a female broker. Her name was Ann Papa. And after about a month or two, I started giving her projections, cycle work, not the kind I do now, but preliminary type of cycle projections. And she said to me one day, she said, you know, I talked to my boss about you, and he's fascinated because you've been calling the market better than all the people we pay a lot of money to do that. He said, my boss wants to talk to you. I went and talked to the head of the firm. He said, would you like to be on television? Mr. Show Business said, oh, yeah, I would love that. So I started doing commentary in Los Angeles. And one of the first calls that I ever made was in 73, 74. I know that goes back a long way. Some of you weren't even born at that time. But especially going into the fall of 74, I kept showing. And in those days, we didn't have any computer generated graphics. You would put the chart up in front of the camera and say, look at this. And I showed a 212-week cycle in the stock market and kept saying, this cycle is due to resolve on December 9th to 13th of 1974. So I predicted what should be a very major bottom at that time. Well, lo and behold, on December 9th, 1974, the exact bottom of the stock market was reached. This is on the Dow. There was a double bottom October, November, but December 9th of 1974, and the rest is history. That's when I started my newsletter 6 months later, and I have been a fanatic cycle person ever since. That's the background. Now I'm going to start showing you some stuff. I'm going to share my screen, and I want to show you those, especially those of you, this might not be new for some of you, but for those of you that are new to the cycles business, I want to share a few things with you, okay? So let me do this and share. Okay, so this is sine wave animation, the theory of market movement. And I present this as a typical stock chart. You can see a support line here. Here's a trend line with 1, 2, 3, 4 hits on the trend line. The trend line is broken above, as might be expected. The market starts to move up. It forms a little triangle here. You break out of the triangle and zoom to the upside, as might be expected. Okay, so what is this? Is this an actual stock? No, it's not an actual stock. Let me show you what this is. What I did was I put together 4 idealized cycles. Now, I don't mean to suggest to you that these are exact cycles that occur in the market. These are idealized cycles. This cycle, it's a sine wave that would represent the long-term cycle, okay? So that's the longest one. Then we have a couple of intermediate term cycles. There's the orange line representing another sine wave. Here's the third sine wave, a shorter cycle than that. And then the shortest sine wave of all is this little orange one, okay? So now you have 4 sine waves, okay? Now, generally speaking, what we say is the sine waves determine the movement to the market, but you also have to keep, people ask about fundamentals. Yes, fundamentals act on the market, but in a smooth fashion, either a smooth fashion up or down, and it can always change. The fundamental line I have put in here slants to the upside. So now what we do is we add together every movement of each one of the 4 sine waves and this fundamental line right here. And what happens is, watch this unfold. That green line that's unfolding is the exact line that I showed you in this chart right here. Let me go back to it again quickly. There it is. That's the exact same line. combination, a simple combination of 4 sine waves and a fundamental line, okay? So, and again, I want to emphasize this is in an idealized fashion. I am not suggesting that this is the Dow Jones Industrial Average or the S&P 500. It shows you the way cycles combine. There they are. There's the same line again, the green one, okay? Now let's apply this to the analysis of cycles and how we make cycle projections. Okay, let's assume this is one of the sine waves that we showed, and it applies to all of them. There's 20 weeks between tops and 20 weeks between bottoms. Remember, it is an idealized sine wave. So what we do to determine and make predictions on where that cycle will top and bottom is we do an offset, 1/2 the distance of the length of the cycle. This is a 20-week cycle, top to top, bottom to bottom. So we move the sine wave over 10 weeks. And when you move it over 10 weeks, this is what happens. See this dashed line here? It meets the actual cycle movement at exactly the halfway point. So once you cross above this sine wave, then you know exactly where it should end in terms of its upside movement, okay? Crosses at the exact halfway point. Here's the ending of it, okay? Let me show an idealized, and again, remember that word, it is idealized, a bar chart that gives you the same idea as to what goes on. So here's a bar chart. Obviously, you're not going to see a perfect cycle like this in a bar chart. But again, this is idealized to give you an idea as to how the cycle projections take place. We have a move to the downside and we put our offset on, okay? There's the offset. This is a 20-week cycle, 20 weeks between tops and bottoms. And if you move it over 10 weeks, you offset it to the right, 10 weeks, it should cross exactly at the halfway point. So once you have prices move below this sine wave, then you can look at where the occurrence of the juncture took place of the actual stock prices and the offset line. That would be right here. On this bar right here, you've had the crossing. And so you can do your calculation for the cycles. The high was 21. The crossing was at 15. That's 6 points. So 15 minus 6 more points takes you down to 9, okay? That's the theory of how price projections work with the Hurst cycle theory. Now, Hurst put together what he called nominal cycles, and nominal simply means a name given to them. There are nominal 5-week, 10-week, 20-week, 39 to 40 week, 100 to 110 weeks. That would be about 2 years. And when you multiply the nominal offsets, when you multiply the offsets, they represent the cycle. So a 10-week offset, as you see here, would be for measuring the 20-week cycle. A 20-week offset would measure the 40-week cycle, the nominal 40-week cycle, okay? And the same goes onward to the highest offset that I use on a practical basis. Usually it's around 2 years for the 4-year cycle, but if we have time, I'll show you some 4-year offsets, which would be 200 to 220 weeks, that give some pretty darn good projections for what would be a 16, 17-year cycle. So 8 years, 4-year offset, 8 years. Anyway, that's the theory behind how these cycle projections take place. So now that you know the theory, let me go to some actual charts. Okay, I think I'll start out with, well, let's stay where we are right here. This is a monthly chart, actually a weekly chart of the Dow Jones Industrial Average. So I know this looks like a very busy chart, and I can change it to look less busy by putting up what I call the web chart. the web chart. And by the way, this software was written for me by Stefan Scheuermann from, he's a German fellow who now lives in Dubai, and a brilliant software programmer, because believe me, I looked for someone to do this for me for a long, long time. Stefan was finally able to do it. So here's now the web chart. It's a lot clearer and it shows you, okay, here are the projections that were given by this particular offset. The offset that we're looking at now is a very short one, 2.5 weeks long. The reason I put 2.5 and 2.501 is that the software requires two inputs. Usually on the daily charts, I have inputs that go from, for example, 3.5 to 4 days. I'll show those to you. But in order to satisfy the software, the 2.5 is all we really need, but it's 2.5 to 2.51, and then you get your projections. Whenever you get a crossing, it gives a projection. For example, here's a high. We got a crossing on this week, and it gave a very short-term projection here. It was given and met on the same week. Once you meet a projection, you go out to the next longer offset. This is a 5-week offset for a nominal 10-week projection. Let's get back to that chart. Okay, so here it is. Bear with me here because things are acting up on me a little bit, as they always do when you make a formal presentation. Let me get back to here, and okay, I want to do this and say show web chart, and show me the web chart now. There we go. So this is the Industrials Weekly 5-week offset. Let me zoom in a little bit here. This is probably not a good example because you can see when there's gray, it means a projection was not reached. When there's a color, either red or green, it means the projection was reached. The green ones are upside projections. The red ones are downside projections. So you might say, well, this one was reached to the downside, but you went even lower. Yes, once you reach a projection, you go to the next longer offset for longer cycles to see if they have generated even lower projections when you're looking at downsides. On the upside projections, you'll notice this one was missed, but by very little. The upside projection called for a move to at least 37,085, and the high here was about 36,900. Okay, so as you can see visually, it was very close. This one was missed by a long distance, but let's take a look at it in real time. Okay, so once a projection is given, it remains in effect until either met or invalidated. How do you invalidate a projection? You invalidate a projection by crossing back below the offset line, okay? So we're looking now at 5-week offsets, nominal 10-week projections. This upside projection, we didn't even come close to it. But after going sideways for 3 or 4 weeks, and this week right here, you knew this projection was no longer in effect. It was not only invalidated, but a new downside projection was given to this low level right here. And again, it was given and met in the same week. What do? You go to the next longer offset. Here's a 10-week offset. I don't know why this chart keeps popping up. Don't do that. Okay, just testing my patience. Sorry for this delay, but let me show the web chart. Here we go. Okay, so now here's the web chart, and this is a 10-week offset, okay? Now, you can barely see the offset line here. It's this very light line right here that's offset of 10 weeks, okay? So you can see the downside projections, especially after the trend turns. When you're in a downtrend, the downside projections tend to be more accurate. When you're in an uptrend, the upsides tend to be more accurate. But you can see from this that we have 1, 2, 3, 4, 5, 6, 7, 8, 9 projections, and only 2 of them were invalidated. So that was 7 out of 9. Here's the great thing about the software. If you go to right click on one of the offset lines and say, show statistics, here are the statistics, okay? So you know with every offset, once you look at it, what percentage of them have been met. In this case, the upsides, that's not very good. Confirmed upside projections, there were 28 given, 14 of them met. Usually you will get at least the high 60s to low 70s projection success, okay? As you can see, this one was 50. That's 50-50 chance, no good. But look at the downside projections. 26 out of 29 downside projections met. 90% of the downside projections were met, okay? So that's the fabulous thing about this software. The way Stefan set it up is once you use an offset, you can check on its accuracy going back. And this also tells you how far back you're going. So this is almost 10 years here. This is from August of 13 to July of 22. You can go back as far as you want historically, or as short a distance as you want. But this is telling us that for the last 10 years, 90% of the downside projections were met. Let's keep going out on this so I can bring you up to the current time period. You can see what's going on. These are 20-week projections. And as you can see, we initially got this. These are 20-week offsets for 20-week offset for a nominal 40-week projection. And I'm just going to keep going out on these so you can see where we get to be currently. Okay, this is a little tricky here, and this is real world stuff you're looking at, folks. So I'm going to show you the bad along with the good. This downside projection was given right here this week. And then you had a little bit move to the upside here. That had validated this, so it turned gray. This one was missed by the narrowest of margins. And very quickly, after a couple of weeks, we went back below the line again. Usually in situations like this, what you can do is notice that this was only a 2 or 3 week excursion and slightly above the offsets. So here's another thing you can do with the software. You bring up the parameters and you say, I want to put a filter in here because that was only 2 or 3 weeks that we got above it. Let's put in a 3-week filter and see what happens. So if you put in that 3-week filter, notice that this projection remains intact. And indeed, we went up, we get a tiny bit above the offsets, but from this high, with a breaking of this offset to the downside, these are the projections that were given for the Dow. 30,669 rounded off to 31,811 rounded off. And you'll notice what we can do is extend this to the right and look at this. Virtually perfect to the downside. Then we had a rally. So what happens when you have rallies after you meet projections, whether they're the upside or the downside, you get what I call loop projections. So you rally off that bottom to the upside, and that creates a situation where you can come back down through offsets that have been created by the rally and get further downside projections. In order to look at those, we go to a daily chart. Let's do that now. Okay, here's the S&P. These are daily charts. So the S&P, let me show you, let's follow along with these offsets and these projections of the S&P. This is a 12.1 to 13.8. I know it's crazy, and a lot of you people that have done Hurst work before use calendar days. I don't use calendar days. It was a little awkward going back 30, 40 years to attempt to do calendar day charts, although I did them for a long time I do them by hand. You draw the 5 days and then you leave Saturdays and Sundays blank, because at least in theory, cycles continue through that purview of time, Monday through Sunday, okay? But I said, there's got to be a way where you can do accurate projections with market day charts. And so I transformed the offsets from what would be, this would be a 2.5 week offset. And I said, how many trading days would that be? And it worked out to be fractional, 12.1 to 13.8. I'm not going to go into the details. I just want to give you a quick feel for what these offsets and the reason for them. Now, typically, a 5 week offset would be 25 days, 5 times 5, 25. But remember, there are holidays and you don't always get exactly 5 trading days in a week. If you work it out through the year, this is what I came up with, 24.2 to 27.6. Let's stay at this one first, because I want you to look at these projections. Now, I've set it up so you can do both closing price and intraday projections. The way you do that, we double click this again. These are closing price projections. In other words, they tell you what the projections are for market closes. I can change this to median price, MEDIAN, which would use the median of every bar. Let me show you what that looks like on the chart here. Okay, so this takes the midpoint of every day for the market and creates a median price, which is where those projections would come from. And they actually project extremes, okay? So the median projections are extreme projections that would be different from the closes. Usually, they'd be higher on the upside and lower on the downside, almost always, okay? So I just wanted to show you that, but let me go back to the closing prices again, because these are closing price projections. So what we have here, and look what we've done. We have upside projections, and these have been virtually perfect over the past several months. This was an upside projection for a close. We came right a little bit above it. I think there was a longer cycle that pinpointed that. We came down and indeed met this projection to the downside. Did we go further? Yes, but then you go out to your longer offsets. This was an upside projection, met this rally that topped on June 2nd, perfectly came into the upside projection window. That led to a downside projection. That was met perfectly down here. That led to an upside projection. And the software is very picky. Notice this right here. Here's the box. It missed by the tiniest of margins, but because it did not get fully into the box, that was called a miss and it was gray, okay? So obviously the big question now is, okay, what do the projections currently call for? Let's take a look at the most recent projections. This is the S&P, and we're going to go through. Well, first of all, let me tell you what happens here. This was the projection on the weekly chart right here. Once we met that projection, I said at that time that this was a candidate for an important market bottom to see a good stock market rally from there, okay? Mind you, I felt all along that this was nowhere near where a bear market bottom was going to be, but we had exhausted all the downside projections, so there weren't any more to get, okay? But what happens after that is you start a rally, and as you rally, and notice how good this projection was to this high, as you rally, you build up an offset, which is right here. Here's the offset of this rally, and that puts you in a position where you can get what I call loop projections. You get yourself a little loop to the upside after you've exhausted all downside projections, and with that loop, you can get additional downsides. Look what happened. We met this upside projection, and we got this loop projection to the downside. That was met right here, virtually perfectly. And once those are all met, all the loops, and when I say all of them, you have to look at each one of the offsets. In this case, these are the only ones that were surpassed. 175 to 2, 3.5 to 4, 7 to 8, 12 to 1. The 24.2 to 27.6 from this low. Let me show you that one so you can see what I'm talking about. And I realize I'm going through this very quickly, and it's not that easy to see what's going on. But notice that once this low was reached, we never got above this 24.2 to 27.6 offset, okay? So when this high was reached, the only way you could have gotten a higher projection would have been to cross above this offset. That's the one we just looked at. It's a lot easier to see on this chart right here. Here's the rally. Here's the offset. This is what I call the continuum. Notice that it's a 24.2 to 27.6 offset. The continuum represents all the movements in between 24.2 to 27.6. In order to have gotten an upside projection here, you would have to not only get into the continuum, but above it. And we never did that. So we had this downside projection, and then we have what I would call a move. We got this move down here, and then we started another move to the upside. This is where we stand currently, because I don't have too much more time. I want to allow time for questions too. Where we stand currently is we came down to this low and this low again, because it exhausted all the possible loop projections to the downside. This low represented the lowest projection that we can get. I think it allowed for a little bit further to the downside, but not much further to the downside, okay? So once this was reached, again, I said, we have reached all downside projections. The only way to get lower would be to see a rally from here. Here's the rally. We went up, down, up. And here we are today. This is today's close right here. You click on that, July 14th of 22. So the question is, have we met all downside projections? Well, let's take a look. Let's start from the 3.5 to 4. Look how close this is. Here's the downside projection right here. And the question is, you say, is it good enough for military work? Military people don't like it when you say that. So the downside projection, all you have to do is click on that offset. You zoom what's going on here. And it not only gives you the window, that's this red part here, but it gives you the actual numbers. 37.73 rounded off to 37.82. Well, we closed today at 37.90, about 8 points away. So technically, we did not fully meet this projection. Let's take a look at the longer ones. This is pretty darn close, though. Let's take a look at the next longer offset. 7 to 8. Okay, I'm not even going to look. I shouldn't look at this one because this one's too messy. We had the rally above the offset lines coming back down again. And this has given a significantly lower projection. But let me show this to you on the web chart again, because it's easier to see here. So, okay, see what a mess this is? This upside projection was very clearly given. Prices rose above what I call the continuum, the offsets, gave this perfect projection right here, then started coming down. Well, they never crossed below the continuum to give a down projection. They started moving up again, and there was no clear movement here. When we finally did get a move clearly below the continuum, and look where the projection called for, okay? So this was very close in terms of being met. And if we go to the next longer offset, which is the 12.1 to 13, let's go to the web chart again, because that always gives a clearer picture. Okay, and this should be closes, so we put closing prices on there. So today, this was confirmed for lower closes, okay? Confirmed closing projection to between 36.84 and change, and 37.26. This is a confirmed downside projection. So you can write that down and know that we do have a confirmed lower projection. Here's what you have to note. Only two things can happen when you have a confirmed projection. And that is, one, the projection is met, or two, the projection is invalidated. The only way to invalidate this projection would be to see a close above the continuum, okay? You could have a big rally tomorrow and it would not get above this continuum unless you had a rally of, this is like almost a 100-point rally from this close. Over the next 3 or 4 days, you could invalidate it fairly easily. But look at the consistency of these projections. The downside was met, upside was met, downside was met. These are almost perfect projections, upside, downside. This was almost perfect, missed by maybe a fingernail right here. And now we have a downside. We're going to see how that works out. I want to show you one more thing, and then we'll open up for questions. The reason I think that we're in an area where we should be looking for short to intermediate term market bottom is we don't have any big downsides left. Let me show you the longer offset that we did not look at. In fact, I'm going to do this on a weekly chart. It's easier to see. And I'll put in SPX.X. Oh, sure, give me a hard time. SPX.X. Here we go. Okay, make it full screen. Bring it over towards the middle. Okay, remember now I showed you this downside projection was a longer term downside projection. It was the offset here was 39 to 40 weeks. That's a nominal 78 to 80 week projection. The only way you could get lower projections was this little loop to the upside and down. And I just showed you those on the daily charts, okay? Excuse me. Let me show you the next longer offset and why there are no long-term downside projections to be given. This is a 2-year offset. If we get below there, you're talking about big time downside projections, okay? This is the all-time high back in January, around 48.19. The crossing here, and you have to cross below both these lines, would take place around 3,200, 3,100. So from 38 to 31 is 700 points. You're talking about a move down to the mid-2000s if and when we cross this line. I think this line will be crossed, but later on, probably coming into, I'm guessing, and this is only a guess, this is not what cycles are telling me. I think from this point around here, we rally into the early, perhaps September time period. Labor Day is a great time zone for tops in very overvalued markets. And believe me, this one is still very overvalued. So this is my guess. And right now, it's not a cycle projection, it's a guess. We're going to get a move up into this time zone, and then we'll get the kind of loop projection that can lead us below these offset lines. Once you go below these offset lines, then you refer back to this high and this crossing for the next projection. Let me show you these lines in the NASDAQ 100 because they're a lot closer. If you cross below both of these lines, and let me show this to you on the web chart. See, what happens on the web chart is the web chart moves this red line, which is 100 weeks, slowly to the right until it meets the blue line. And that forms a continuum. And this is my own interpretation of the Hurst work. Once you do that, you need to cross above or below that full continuum. Let me show it to you on this chart here. Okay, here's the continuum, okay? So here's what we have. Here is the NDX, the weekly prices. Here's the continuum. In order to confirm this downside projection, you need to get fully below the midpoint, the median of the week needs to get fully below the continuum. So I don't think that can happen here. I don't think we have a way to get projections this low in the next several weeks to give a much lower projection. What I think is going to happen is a nice rally into this time zone, and then we can have a loop projection to the downside, carrying below the continuum here, giving significantly lower nominal 4-year downside projections. And with that, we're 45 minutes into the presentation. I'm going to open up for questions.
Fascinating insights, Peter. Thank you very much. And I can see there's a busy Q&A in the chat right now, so I'll jump straight to it.
Sure.
Early on, you spoke about, I mean, it was a great intro as well in terms of how cycles develop and relate back to Hurst. And then you also mentioned something about the fundamental line. So there was 1 or 2 questions on that in terms of what is it and does it change over time?
Sure. Yeah, well, the fundamental line is something that we cannot measure. So let me show it to you here. Here's the fundamental line, okay? This was just by me a hypothesis to show people how fundamentals act on the market, because most people think that fundamentals determine the short-term moves of the market. Oh, the Federal Reserve did this, and oh, the economy did that, and oh, this report showed that. This line changes, and I don't know how it changes, okay? The cycles, hopefully, when I do the analysis that I showed, will show me how this line is changing, because the cycles will show us that when we do our projections, they take into account what this fundamental line does. The only reason I showed this fundamental line was to show that indeed fundamentals are important to the overall market, but they move in a smooth fashion. Now, on a hypothetical basis, this line could be going like this, and then all of a sudden turn to the downside, and we start getting a line that either goes sideways here or starts to go down. Perhaps in a bear market, it'll go down and emphasize downside movements, okay? Let me point out one other thing while we look at this chart. A lot of people say, well, you claimed that there was a cycle bottom right here, okay? How come the market bottomed over here? See, the green line is supposedly the representation of all 4 cycles along with the fundamental line. Notice that this is the bottom of the long-term cycle, but the price bottom occurred over here. And that's because of the shorter cycles interacting. So you won't always get a price bottom. The bottom line of what I'm saying is price bottoms do not always synchronize with long-term cycle tops and bottoms. Same thing at the top here. Look at the top of the long-term cycle, the blue line. That topped right about here. So notice we had a top very close to it, but then we had these are what I call the loop projections that happen with the cycle offsets. See, you might get a projection that comes up to here, and then you have a move down and a little loop that causes this last ditch move to the upside before all the cycles start operating strongly to the downside. So I hope that answers the question.
Thank you, Peter, and more. There's a question on cycle frequency from Michael. What is the smallest consistent cycle length you have found in financial markets, and what should be the offset for it?
Okay.
Are these calendar days or market days? That's the additional detail.
Okay, well, the way that I can do that is to show you a chart. I go down to periods as short as this is the S&P future daytime prices only, because I have a chart that includes Globex. And so the shortest offset I have on this chart is 328 to 375. So that would be, let's say 3 to 4 would be the half span. So that would make a 6 to 8 period cycle. Well, 6 to 8 27-minute cycles, you're talking about a cycle as short as 3 hours, 4 hours, okay? That doesn't mean that is the shortest cycle that can be measured. It means that that's around the shortest term cycle that I use on a practical basis to give me cycle projection. Okay. So cycles go down to the very smallest frequencies, and some of them so small that we don't care to measure them. It's like minutes, let's say, minutes or an hour or so. But I do measure the very short-term ones also on my intraday charts. And while we're looking at this, look at this downside projection, this box right here. And this was the low that we saw this morning. This is the July 14th low on the S&P at 3723.75. The projection called for 3634 to 3727 rounded off. And the low was 3723 into projection. So yeah, we do short-term projections also.
Great. And while we have the chart up there, Peter, there's a question from Pierre about the offset for the red and blue line, or the distance between them. Is this in relation to the cycle offset? I think that's the question.
Yeah, well, see, this offset is the equivalent of a 7 to 8 day offset. But because these are almost half-hour bars, 7 to 8 days, the difference from one day to another is there are in the stock index futures 27-minute charts, there are 15 bars in a day. So if we quickly count here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, that is one market day right in here. So this offset goes from the equivalent of 7 days, the red line, to the equivalent of 8 days, the blue line. And you have to take into consideration any crossing that happens between them. And that's where the continuum comes in. And that's why, let's show the continuum again, show the web chart. Here's the continuum. I hope it pops up. So here's the continuum right here. That's the difference between the, well, this is actually 105 to 1, yeah, 105 to 120. That's the equivalent of 7 to 8 days. And notice that these are thick. They're thick compared to the single bar chart that represents 27 minutes. And notice how, again, this projection was reached virtually perfectly early. It looks like earlier this morning. But the reason for the difference between them, the distance between them, is that, again, this represents 7 to 8 trading days, but there's 15 bars in a trading day. I hope that explains it.
Yes, and there's just one, there's two additional tech questions on the cycle. One on the 27-minute, while we're on topic. What other aggregation periods should we consider? So why 27 minutes, and are there others that cycle specialists should consider?
Yeah, the reason I use 27 minutes is I wanted to fit them exactly into a market day. So the futures trade for 415 minutes outside of Globex on a typical trading day. It's 415 minutes. No, it's 390, 405. So 390 for the cash markets, 405 for the futures markets. If you divide 405 by 15, it'll give you 27. So I wanted to find a time period that would fit exactly equally into the market day, okay? And that's why I use 27-minute bars, and there are 15 of them in a day, okay? It's an arbitrary usage, okay? There's nothing that says you have to use 27 minutes, but I wanted to find something around a half an hour. By the way, let me show you how I do this. If I want to look at the cash, I would go to time frame, customize, put in the symbol for the S&P cash, $SPX.X. Now they would become 30-minute bars, because in a market day, there are 13 30-minute bars in a day. And so that would look like this. Okay, there we are with the 30-minute bars, and this is on the S&P cash. So that's the reason why it's arbitrary, but it was determined by me that wanted to break up cycles into shorter periods. So indeed, this is the way we attempted to do it. Okay.
Thank you so much. The final set of questions, Peter, I'm trying to group them in terms of themes so we can get a broad brushstroke. So the next set are all to do with trading application, how you trade these cycles in terms of entry and exit. So this question specifically, let me get to it. When trading, do you exit at the lower end of the projection? Roughly speaking, what is the ratio between profits and losses? That's from Mark.
Okay, now there is no ratio between profits and losses, because what this is doing, what the software is doing, is giving you projections. Then you've got to go to the human head to figure out how you're going to use those projections. Here's one suggestion, and it's only one. What you're seeing on the screen now is this is an hourly chart, okay? And those offsets, again, the software determines them. This offset is, this is a 3.5 to 4, 7 to 8. This is a 12.1 to 13.8. So again, look at how perfectly just entering into the window this morning at the low. How do you trade this? Well, one of the ways to trade it is to wait until a projection is met. Once you get into the projection window, obviously with the downside projection, is you're looking for an opportunity to enter on the long side. This will not tell you to enter necessarily on the long side, because you still have a real big window here of possibility to the downside. What you want to see is a movement that starts to the upside and starts to generate upside projections. There are a couple of ways to do that. What I would do, first of all, is go to the very shortest offset. This is an hourly chart we're looking at now. So that's a 263 to 5. And let's take a look at this. And you'll see what starts to happen here. Let me zoom in on this. So we met this downside projection right here. Now, these are not the original projections. These are new projections for the shortest term offset. Notice that when you got on this bar right here, you would have gotten this upside projection, okay? So because you know you've met a downside here, and on the very shortest term offsets, you've generated an upside, then that would be a time to possibly take some kind of market action on the upside, okay? You want to see some kind of confirmation that indeed, as you entered the projection window here, you've started to get upside projections here. So for an example, you could have entered here. This bar closed at 37.66.45. This is on the cash, not the futures, but it applies to the futures. And you had this upside projection. So now when you meet this upside projection, you go to the next longer offset and say, have I generated an even higher projection? And look at this, look how close we are. So here's what's happening. This is interesting. We went above the initial offset line. It's this red line right here, but we have not gone above the blue one. That's required for confirmation of this upside projection. This crossing has given a preliminary upside all the way up to 38.49 and change, but that will not be confirmed until sometime tomorrow, where you have to go above this second line. Well, the only way you're going to avoid that tomorrow is to have a huge downside opening way down here. Otherwise, almost no matter what happens here, you're going to confirm this upside projection. So what we're looking at now leads me to suggest that perhaps we've seen some kind of market bottom here, and that any kind of sideways to up opening tomorrow would guarantee an upside, not guarantee, but would give or generate an upside projection to at least 38.49. And depending on where we cross the blue line, even higher than that. I hope that answers the question.
Yes, it does. And as a final wrap question, Peter, as we hit the hour, variations of the same question from both Johnny and Lynn on exactly this chart, S&P 500, what you alluded to in terms of a potential midsummer rally that then takes us into a potential mean reversion risk into the autumn season.
Right.
Specifically, the question is, if I quote the one from Johnny, how high can the rally go into September, and then as a second part to that, what would be potentially the ultimate low to this bear market?
Okay, so now you're talking things where there'll be completely hypotheses. Okay, with these are guessing games. I try not to do that. I mean, I give ideas. I show people, in fact, that when I showed the S&P chart, I showed you possible crossings of it. And depending on where we cross below it, that long-term offset of 2 years, excuse me, well, depending on where we cross below that long-term offset, that would give, I think I showed possible projections to the mid 2000s, and it could even be lower. Okay. So, but that's got nothing to do with the real world cycle projections. I shouldn't say there's nothing to do with it, but at this point, it's only guessing. How high could we get first? Well, we don't know that until we start seeing these crossings take place. So we're looking, this is exciting because you're seeing in real time how the S&P hit a bottom projection and how it's very, very close to giving an upside projection to at least the 3849 level. So, you know, that's another 60 points up from here. And that will be confirmed with any kind of sideways to up opening tomorrow. In fact, you could even have a slightly lower opening and still cross above this secondary line. And then you just take the offsets one by one. When you've gotten to a point to the upside where all upside projections have been met and no further ones are given, that should be your market top.
Thank you so much, Peter. And just as a final question from my side, I wanted to get it in there while still possible. Sure. Many people are asking for your, how to access the software and YouTube channels. I've just shared those details on the chat. But as I was doing so on your YouTube channel, I noticed in Feb, there was a historical analog of 1929-87. What happens just before a crash? What quick insights can you share with us on that?
Okay, well, that was very fascinating because for a long time, for several weeks, we followed that analog very closely. And the moment, you know, analogs are interesting animals. So, I mean, they're fun, but the moment they go off track, and they almost always do, once you start looking at analogs, then you should no longer follow it. That analog followed very nicely for a while. In fact, people could have benefited from it because we had a good size move to the downside there. But then I don't remember what the date was. It stopped. The analog stopped, and that's when you should stop hoping that it goes on, because once it stops working, then you don't count on it any longer. Give me the opportunity, Ron, to tell people that are interested in the software. We now have a problem with TradeStation because they are going to stop doing third-party applications. But if people are interested in following the work and what these projections show, they can simply go to my website, stockmarketcycles.com, and go to the register part. And we offer a 2-week free trial, both for the software and the videos that I do daily. But unfortunately, because of what's happening with TradeStation, they can't get the software anymore. We're hoping to make it available in a different way in the very near future. But right now, the only things that they can get is they can register for a free 2-week trial to our daily videos that do this analysis on a daily basis.
Thank you so much. Many people were asking about that, so they can now follow up. We'll make sure we share the links. And of course, I know FSC board member Lars von Thienen will have you back on Cycles TV, so there'll be plenty to discuss in future. Jake Bernstein has wonderful words to share. Brilliant work, Peter. Like a great California wine, you have perfected with age.
Oh, thank you very much. And everyone stay tuned because my friend Bill Sarubbi's coming up. You don't want to miss him. Hi, Bill.
Thank you very much. Okay, now progressing on after a very active Q&A session, exactly as Peter was just saying, we are now following up to FSC board member Bill Sarubbi, who will be looking at US stocks, real estate, and the economy, building on his early insights from this year. Bill Sarubbi is a money management consultant and a Forbes contributor from 1972 to 1990. He worked on the buy and sell side of Wall Street as an analyst, an institutional broker, and a technical strategist with Payne Weber. From 1990 to 2004, he was with Abu Dhabi Investment Authority, where he was a technology fund manager, North American strategist, and member of the Currency Hedging Committee. He has developed his own market analysis software too, and I'll let Bill take it from there. Welcome back, Bill.
Hello, can you hear me okay?
Yes, loud and clear, and I'll stop sharing so that you can then take control.
So the stock market likely to rally in August. I think it's bottomed around now. Maybe it was today or maybe it's Monday. The technicals and the cycles are not in agreement in that the technicals look much weaker than the cycles would suggest to me. I'll discuss that as I go on. Well, tech stocks, I should know because that was been my specialty. At the end of last year, had I not had any cycles, I would have been bearish anyway, because the mathematical odds of tech stocks putting on the type of performance they put on for the previous 2 to 3 years were minimal, about 1 in 3 or 1 in 4. And of course, they are so much market cap that the overall indices cannot hold up if tech stocks decline. And I remember reading a study years ago, 50 stocks account for 75% of the volume in the NASDAQ. That's 50 stocks, 75% of the volume. There are 5,000 stocks in the NASDAQ, so that's 1% of the stocks, 75% of the volume. That's how important they are to the indices. Also, I believe the bonds, the 10-year note already started a rally that will persist through August. I think gold is bottoming in the last week of this month, and the US dollar, the last item, is the strongest. I think that will remain quite strong. And that is the last chart. So I'll go through this pretty quickly because it hasn't changed much, but I felt that the fundamentals were deteriorating quite badly and were getting somewhat Weimar-like in that they were pushing credit into the system while the fundamentals just fell apart. And I think that's becoming more and more obvious. I've been in America for 3 months, so I've seen the news. And this increase in inflation, as I said last time, is not transitory. And the real estate cycle tops, which we'll look at that in 2023. And I'm already seeing tops signs of that in New York, New Jersey, and Connecticut. When that goes, that will reduce consumers' ability to spend because they look at the appreciated value of their home as credit to draw on. And the excesses in the auction market, which I watch closely, are one sign of a credit bubble. Bubbles have historically burst in the autumn of years ending in 7 or 8. Excess inflation may distort these historical trends. And the equity market is due to decline in 2022. Real estate is likely to follow in 2023. And as I said, I doubt, most of the people I talk to are not aware of the declining fundamentals. I'm looking for, I'm not sure about the economy right now, really, but inflation and crime are hurting retail. And as one wise man said once, don't tell me what's going to happen. I know what's going to happen. Tell me when it's going to happen, which is what I think we're all attempting to do. So inflation is worse than reported. Now, this is from John Williams' ShadowStat website. And up here you see the inflation rate being up over 15%. Now, that blue line is the way they used to calculate inflation, CPI. That's the way the government did it, Department of Commerce. Williams has simply maintained the numbers under their old standard. And you can see the difference between reported and what he is saying. So that's just one piece of evidence that the fundamentals are pretty unsound. And this is contrary opinion at its best. Klaus Schwab and Thierry Malloret, at this current juncture, it is hard to imagine how inflation could pick up anytime soon. There's the Schwab comment right down here. And Paul Volcker, who was seen as the guy who ended inflation in 1980, died at that time. And I might also add in, I didn't do it at the time I made up this graph, but this entire stagflation period, the onset of it in the 60s was very accurately forecast by the fellow who wrote The Invisible Crash, James Dines. He wrote the Dines letter, and he forecast declining markets, higher inflation, a very real destruction in purchasing power. His company fired him for predicting that, and so he started the Dines letter and he wrote his book. Well, he just died right in about here, April of this year, just as my plane landed here a few months ago. And isn't it interesting that Volcker would die just as CPI inflation comes back, and that Dines, who forecasted this period many years ago, dies in April, just as this period begins again. That's how contrary opinion works. And so there's an old New York saying, New York City saying from my days there, that cocaine is nature's way of telling you you have too much money. Now, I'm saying the type of action I'm seeing in the auction and real estate markets are telling me there's too much money. The excess liquidity spills over into speculation, and this has led to rallies in all asset classes. There is enough liquidity for everyone to buy anything. But as my old pal Ian Notley used to say, when all asset classes go up together, they all come down together, the classic bubble collapse. So here we are with auction news. $490,000. Don't you wish you had held on to this comic book? One comic book, almost $500,000. If that isn't excessive enough for you, then here you go. It's a ticket stub to the first NBA game of Michael Jordan, win for $264,000. That's a ticket stub. When here, at least you have pictures to look at and something to read and a story. Here, you just have a ticket stub. And I could go on and make this much worse. And an open Super Mario game going for, I think it was hundreds of thousands of dollars. Anyway, here is how some of the last observations worked out, and here are some new ones. The last time I spoke to you earlier this year, I said apply contrary opinion. This is old from the days I was in technology fund. Jeff Bezos and Amazon on the cover of Time, and there's the cover of Time pointing to the Amazon share price. And you can see he appeared on the cover of Time, and you can see what happened subsequently. So I pointed out that Elon Musk was the person of the year. Again, this was earlier this year, if you were at the original conference. And here's an arrow denoting when I pointed this out, when he appeared on the cover of Time, and you can see approximately a 50% decline in Tesla followed. Now, this work was really, I think, I don't want to say it was made a science, but it was much more of an art by Paul McRae Montgomery, who researched 3,200 covers of Time magazine and found out whenever there was an investment-related theme on the front page, that with an average of 80% within 3 to 4 months, the markets would turn, or the asset class would turn in the opposite direction to that which the cover of Time suggested. If the investment story got through to a more popular magazine, let's say People magazine, then you could be doubly certain, because it had gone beyond the financial realm. The information had spilled over and filtered out into the general public. And I'd like to point out, Barron's, was it 2 weeks ago, suggested interest rates were going to go much higher, and bonds have rallied since. That was only about 12, 13 days ago. So that's what I have to say about contrary opinion. Now, the stock market, the way I look at this, if we go, I see two thrusts up in the market here, one from 2020 up to about 2022, but the more important one from 2009, that dreadful bottom back there in March, all the way up to 2021, 2022, that being the more important one. And so this is 38.2%, which I'll talk about in a minute, but it's also 61.8% of the smaller rally. And my friend over in England, Tony Plummer, makes a good point about 38.2%. Art Merrill said it was about a third, but let's use 38.2. He said, if the market holds above 38.2%, then the odds are the fundamentals are intact. If it drops below that, that means that the fundamentals are shifting, or, as I like to add, the perception of the fundamentals may be shifting. So 38.2 has got to hold. If it goes below that, it suggests we're in for a much longer bear market. And as you can see, it is down at these levels are 3,200, 3,300, which I have as a target. And right now we've broken through, hesitate, we're at 23.6% of one, 38.2% of the other, and we're trying to hold in this area. Eventually, I think we're going to wind up down here. I don't know whether it's coming this year or whether it's coming next year. But at that point, I would then be very cautious, because my feeling is, and let me see, yeah, I have it right here, comparison to past bear markets. Well, here we are in light blue over here. And you can see how it compares to those other histograms. And I most liken this period to 73, 74, because I had just got out of school with my MBA and promptly saw everything I was taught not work. And that's when I met people like Joe Granville, Bob Prechter, Frankie Joe, Arch Crawford, people who were trading and making predictions and making money while the funds couldn't make any money. And so that's a period no one expected it. If you were not there, people didn't understand inflation, where it came from. And they kept thinking if there's a recession and a slowdown in demand, that there will be a drop in inflation, not realizing it was excessive credit creation from the central bank. Now, a lot more people know that these days. So, but the point I want to make here is we are not down here, we're still up here, which puts us on a level with this bear market and 2020 with 1987 and so forth. So that's my longer term outlook. And it's very deceptive, because back in, I was a junior analyst at Value Line, and I remember I left NYU and a professor had us read a study. I'm trying to think of the gentleman's name, but he pointed out if you have a large inventory, like companies today, and price inflation pushes the value of your inventory up and you sell it, your profits go up, because you've already got it made, it's already sitting in your inventory. The higher costs have not affected you yet. Those he called illusory inventory profits. And he made a study which showed that inventory profits are inversely related to PE ratios. And he said it was almost as though investors have X-ray vision, where they see right through the income statement and the cash flow, and they realize that's just the inflated value of the inventory. It's not any great increase in business. So that's what we're in right now. One of the ways to measure long-term cycles is, I think a lot of you have heard this, 1, 4, and the 10-year cycle. The 1-year cycle is a seasonal rhythm in any year. The market is weak in September, October. It's strong in the summer, and it's strong in December into January. The 4-year cycle is described as the election year cycle. The 10-year cycle is the decennial pattern. I also use spectral analysis. That takes the most recent data and draws the numbers out and reconstructs it into a cycle independent of these. So it tells you whether these cycles are actually functioning or not. In the year 2016, Timer Digest ranked me #1 market timer. All I did was follow the 1, 4, 10-year market cycles and the 10-day advanced decline differential. In other words, a moving average of advances less declines on a 10-day basis. And that enabled me to identify a couple of corrections, and that was enough to make a very good year for me. Now, here are the 1 and the 4-year, 10-year cycles right now. As you can see, I have up here in red, I have the annual cycle. That always looks the same. You'll notice how weak it is in September. The decennial cycle, and you'll notice it bottoms in October, and the election year cycle in green. Below that, we have the addition or the composite of all these cycles and an arrow pointing to July, which is why I've been looking for some sort of a rally, but I'm very cautious in this bear market. So I have very small positions right now. My biggest positions are long bonds. Now, let me just see what is on the next slide. Okay. The annual cycle, these cycles are what I call static. They're static and then they do not change very much. Maybe in 50 years they will, but right now they don't. The dynamic cycles are the ones I extract, or anybody extracts, right? You use Lars software, my software. Those are based on the most recent data. They are dynamic.
This temperature was not featured in the Texas promotional literature.
I'm sorry, what was that? Okay, I thought somebody asked a question. Anyway,
just a quick audio issue, Bill. Please continue.
This is what Q2 looked like. Now, if this served no other purpose, I said way back in December, the Q2 was going to be the weakest quarter of this year. Has it been? Yes. Well, there you see the 1, 4, and the 10 up at the top. You see the composite at the bottom, and you see it bouncing here in, well, actually, that's back in June. And that is Q3. That is the summation. In other words, from July up until, and you'll notice a very steep drop in September. So at the moment, I think we get some recovery here, maybe over the next 6 weeks, and then we get clobbered. And the average high in any year is September 5th, but that has backed up into late August as more and more people. They're not going to wait for September 5th to sell because everyone else is doing the same thing. So I think you get a very sharp drop. And then I think Q4, no matter how I look at this, and I can sort this by where we are in the election year cycle, where we are on the decennial cycle, with inflation, without inflation, with interest rates rising, with interest rates declining. And no matter how I sort it, September comes up very weak and Q4 comes up very strong. So that is the stock market outlook, and that is Q4 in 2022. And again, it is the composite. I blew it up to make it easy for you to see. And by the way, if I can just jump back a few slides. Election year cycle, decennial cycle, is, of course, was developed by Ameritrust Bank by, I forget his name, but Ameritrust Bank, Edgar Lawrence Smith. The years ending in 2 have brought more bottoms than any other year, and most bottoms occur in October. Now, way back in, what was it, 2001, I wrote into the Old Timer Digest and said I'd like to be rated as, okay, we'll watch your reports for 1 year. And I said, well, the market's declining. We're going into 2002. I said, I think the low will be in October 2002. I stayed short all that time and wound up #1 in the rankings. I was following this. So here you see, I think this is pretty powerful, a decennial cycle bottoming in October. So keep that in mind. And then this is now 2022, 2023. And this is suggesting that we're going to have a low in October and we're not going to get a high until April. Well, that is the buy in October, sell in May period. And this, of course, is the sell in May period right here. So it fits a known rhythm or a known cycle, which gives me some comfort or some assurance that it will work out well. And so what sectors are likely to do well? What has been strong? I run this every week. These are the sectors, and you see energy is #1. Consumer staples #2. Now, let me just say about consumer staples, since I used to have to follow those for value line, which is enough to put you into a Rip Van Winkle state because they hardly ever move. It's a bit surprising that they're #2, but they're seeing people have to eat, and fund managers figure they're not going to go out of business, and it's a good place to stash money if your mandate says you have to be fully invested. Energy, by the way, the average here is 97.5. That is the S&P 500. And you'll notice that the lowest ranked sector is communication services, 90. Highest ranked energy sector, 109. That's 29 or about 30 points. That's been as high as 60 points. I've never seen that in all the years I've kept these numbers. Usually, if you have a very strong market, the difference between the top one and the bottom is 10 to 15. If you have a correction, it's 20 to 25, but never 60. It's a sign of dispersion, as Norman Fosback pointed out in his 1974 book, Stock Market Logic. That means there's some sectors are going one way, and other there's too much of a disparity between the leaders and the laggards. But this is the way it stands right now. And if I was forced to put money into the market right now, I would look at utilities because higher rates would be, I think, positive for them, or I should say lower rates right at the moment. And last time, if you go back and check the slides, I presented the same. These are the S&P groups. Coal was #1. Coal is still #1. And healthcare, you'll notice, is dotting, and the food distributors are all dotting the top 10 list. So it's all the safe stocks, soft drinks, healthcare, beverages, and things like that. This is, if we get a good rally in October, I suspect technology is going to wake up and take over. That's the way it stands right now. Now, this is from the last presentation. This is my cycles analysis monthly applied to the XLK, the Technology Select Spider ETF. And remember, I had pointed out that statistics show that if the technology sector is exceptionally strong in magnitude for about 3 years, the odds of it going up in the next year are like 1 in 4 or 1 in 3. And so this is the way that, look, this confirms that general outlook. And here's how it worked out. This is this graph, but with the actual price data in it. So this doesn't show a low until sometime in later October, which matches what I think the decennial pattern is telling us. The NASDAQ is not going anyplace with the major indices without these stocks coming along, without these companies. And this is the Semiconductor Equipment Industry Group. Way back in 1991, when I went to Abu Dhabi and they gave me the technology portfolio in 91, I said semiconductors are the bricks of the new technology revolution. You're not going anyplace without them. And at that point, you had what they called National Semiconductor. We owned a position in it. And they are, what do you call it, a general maker of chips. I forget the word, a commodity maker of chips, which most of them are. And I said, this is going to change. And LSI Logic went from 3 3/4 to 56 because they developed one chip for the, I think it was the Sega PlayStation. It went up to 56 and it went back down to 10. And I said, the chip makers are going to specialize. And I went out to Silicon Valley and I met Bernie von der Schmidt, the head of Xilinx, which is a very advanced chip at that time, field programmable logic, which they developed. And he agreed with me. He said, certain industries are going to need certain types of chips, and very bright people will see this coming up, and for cell phones, for example, and different types of cell phones. And so that is a very rich area, and it is no longer really a homogeneous group. It depends on what industry they're serving. This is why I watch it so closely. And I also said that this is not the original graph, but this is what I presented to you last time, hasn't changed. And I thought the Chinese market would hit a low in June. Well, as we can say, it hit a low in late April. The fact that it bottomed early to me is a positive, because I was watching the relative strength of all the Southeast Asian stocks and advising people who manage funds out there that the relative strength would turn in favor this year of emerging market stocks over the S&P 500 and a lot of the European markets. And, a lot of them are commodity-based economies. The same thing happened, way back in the 70s. That's where I'm drawing a lot of this from. So the fact that this has happened, I think, is a positive. And this is another one from the last, I showed this slide the last time, my former home of Abu Dhabi. Now I want to be contrary opinion, one of our favorite tools. Back here, let me see, what year was I at? It is 2021, it's 2017 or 18. Right around, let's see, the last time I was in Abu Dhabi was about here. Yeah, it had to be 2019. All the guys that I met with who were young gents when I first went there were now senior gents, and they're running things, and they're all frustrated. And all the institutions were selling their own stock markets, the Abu Dhabi market, the Kuwait market, the Tunisian market. They were selling them all off because they had gone sideways for this whole time. And I said, these guys, having spent half my life there since 1990, they're the greatest contrary timers on energy. If they're tightening up expenses and firing people, you can bet oil is going to go up. And so they said, we're so frustrated, we're selling off all of our holdings of our local markets. And that's probably what caused that sharp sell-off in 2020. And it broke out, as we all know, you just take the measuring formula, that arrow equals that arrow, which predicts about 9,500, 9,600. So that's the setup. Now, here's the cycle. And you'll notice the cycle peak, it went over 9,500, 9,600, and overshot to about 10,100, over 10,000. But look at the cycle, it's followed it all the way down. And here we are. And this indicates sort of a last gasp rally, last chance to get out before this sets in. So again, this is a very thin market, but it's been very amusing and educational to follow a market from its opening days and to watch it. And, things are really, it's probably one of the better places to be in the world right now. And this is the US Notes monthly histogram. This is how I start any analysis. And our old friend, Richard Mogi, who ran the foundation very well for about 10 years back in the 90s, I said to him one day, Richard, is it my imagination, but when you analyze any new market, you should start with the annual cycle. That's what I find. He said, Bill, that's true. That's what I found too. And so this is how I start. And this is a histogram of expected return. In other words, it is the odds that US notes will go up in the month of January, going back 40 years, multiplied times the likelihood that it will go up. So in other words, I'll make something up, if it went up 1%, 30% of the time, the product is 0.3. And as you can see, the June through August run is the best time to own the US 10-year note. What I do then is I extract out, this is a static cycle. I then extract out the dynamic cycle using software. And if they match, then the game is on. Then I start checking the technicals and taking it quite seriously. Now, that is the dynamic cycle. And you'll notice it bottomed a little off the left edge of the screen and it shot straight up. And it goes up, well, not quite to the end of August, but close enough to predict a strong June through August. And I think one of the clues here was the absolute weakest times of the year are the third week in March, June, and September, and to some degree December. Why that is, I do not know. But this time the weakness occurred in early June, and late June wasn't that bad. A trade which I wish I hadn't made, but it's telling me of coming strength, and we've got it right now. And here you see, here's the confirmation. You see the trend line break right here? If I can find the pointer, there it is. That to me now is a confirmation. The minute it breaks through there, it's confirming that the market is recognizing the seasonal strength and the dynamic cycle. So now it's a question of resistance levels. And here you have a downtrending resistance line, and here you have various retracement levels. Of course, you could throw more and more on there. My old friend Joe DiNapoli would call this confluence, where you get, this is, let's just say that this line was a thin ice if you're a bull, and this line, these lines down here are, thicker ice if you are a bear, because they tend to cluster. So by the time I'm finished with this, I'll have many, many different lines on there, including, Gann rate of change lines from the top, regular trend lines, which you already see in there, but I wanted to keep this a bit simple. So I think we're going up into the 120, what's that, 122, 123 area right here, 124. But I'm a little frightened in doing that because on one hand, I feel we're in a high rate environment. On the other hand, the amount of debt outstanding is so gargantuan that I don't see how they can let rates rise very much. And there you go, best income investments. This was Barron's 10 days ago. This suggests that rates, 4th of July, rates are going to 5%, 6%. And when did this occur? This was, let me see, this was right about in here. If it was 10 days ago, maybe it was here. So to me, that was a confirmation. So watch the covers of financial magazines. And one time, Paul and I were, there were 3 people who worked on Sunday, me, Ian Notley, and Paul McRae Montgomery. I called Paul and said, hey, Paul, I just went to the newsstand and all the magazines had sex on the front. Does that mean, or girls on the front, does that mean sex is going out of business? And how can we make a buck out of it? So we both laughed, but little did we realize it was the beginning of the AIDS crisis. And you probably may not remember, but Carter Wallace traded at $60 a share. 5% of their business was manufacturing condoms. The stock went from 60 to 120 in about 1 or 2 months. So again, it's an example of contrary opinion, not a period I like to remember, because I was living right in the center of the gay world in Greenwich Village, New York. Now with gold, we're the same approach. Seasonality is best in August, September. The monthly cycle bottoms at the end of the month. The higher prices are likely through September. Let's take a look. that is the same histogram. It goes back 54 years. June through September is the best time to hold gold. It's been surprisingly weak. And I held off because that weakness baffled me. Ever since they introduced Bitcoin, I have felt that the gold cycles haven't worked as well. And what this is telling you is that August is usually up 60% of the time, September 61. But the expected return in September is very high. And then this flat month here, October, actually the high is around October 15th. It's the second half is deadly bearish for any inflation hedge for some odd reason. We don't know why. So there's the gold monthly cycle. Cycle should be singular. And you can see where it bottoms here. So at the moment, you've got this cycle pointing down in June. There you see the red sell signal in what is a fairly, it's not a strong month. It's usually a month where gold bases to take off into August. And here you see the buy signal coming in July. So I think July, August, and this sell signal, I'm going to wait until I get to that period before I give a sell, because gold is usually very strong in September. A declining dynamic cycle in such a strong seasonal month may only reduce the magnitude of the rally. It will probably not negate it. I have these numbers that come in that are not on the graph that tell me whether this cycle is strengthening or weakening. So I'm a little leery of those that are weakening. Now, the 18-year real estate cycle was described by Fred Harrison in the book Boom Bust, but it was fully revealed or revived, I should say, by my friend Phil Anderson in London, The Secret Life of Real Estate and Banking, excellent book, which explains the cycle thoroughly and traces this rhythm and credit cycles back through history. So I remember calling him and I said, Phil, it looks to me like this cycle bottoms in, well, let me show you the cycle. I said, this cycle, it looks like it bottomed at around 2009. Would you agree? He said, yeah. So that is here, right at the beginning. Then you get 7 years of moderately rising prices because people have been burnt over here in the bear market and they're not too certain about real estate. They want to make sure they're on firm footing. That's what they do here. Then, once they feel confident, they become overly confident. You get this 7-year burst. And the last 2 years were called the winner's curse. And so I said to Phil, if 2016, that's the year of the election, my guess is an administration that is perceived as business friendly will come in, real estate will take off, and it will not top until 2023. And then you'll have a sharp sell-off for 4 years. I don't think the sell-off is going to be as bad in percentage terms this time as last time around, because there's also a credit cycle, which is about 36, 38 years long, that also declined. So not only were real estate prices declining, prices were topping. People were unwilling to borrow. They didn't want credit. And I also see signs of this. I see signs here. Here's a very long-term view. The Amsterdam Real Housing Price Index. Yes, that goes back to 1620. That's not, it's not 1920, it's 1620. And look where Amsterdam real estate prices are. And here homes are less affordable. This is a ratio of a new home price to per capita disposable income. So down here, houses easily affordable. Up here, not affordable. It's at the highest levels going back into the mid-70s. So I really don't see how real estate can go much higher. And the home, the place I'm sitting in, I bought in 2012, has increased in value by 4 times. 2012 to the present is 10 years. And around here, I see all sorts of signs of people are unwilling to bid on houses they haven't seen yet, or they want they're not in such a rush. The average house is on the market for 17 days before it's sold. Here's homes less affordable. Australia, that's 10.5 times median, 10.5 times disposable income or median income divided by the house price. And here it is in the US, that's 5.8. So this is Australia, this is the US, And this is also true, as you've seen in Amsterdam. I'm sure that is the case everywhere. And here you go, contrary opinion. Now, this is from a couple of weeks ago, but I threw this in just for laughs. This is that was December. Oh, this wasn't in the last presentation. I just included it again. One of the reasons I was so cautious. Now, here I think is the big story, and the reason I say that is because I took one look at that. You see that cycle line? I haven't changed that in a couple of years. What happens is the cycles sometimes they tend to deteriorate. They no longer fit the price data. They get a little out of line. It's like a pitcher who's pitching and he can't find the strike zone. He keeps walking batters and they have to take him out. Sometimes when these numbers deteriorate enough, I've got to pull the cycle out and rerun it, because a new cycle that is from the time of the Pharaoh or whenever has emerged, is awakened up, and it is perturbing the current price. So this has been going up, and I've been telling people, I said, if there's any one thing I'm certain of, the dollar's going to go higher. When they ask me why, it's a very simple answer. When I got to the Middle East, 1991, and every time I go there, the US is they feel the safest haven. It's got a reasonably functioning legal system. It's got a somewhat sound currency. It's the least worst of all the currencies. In other words, it's the least worst place to be. They at least have laws here, and you're hopefully not going to have a revolution like they might have in a smaller country. These, to me, are dollars fleeing the fundamentals they see around the world, which is one of the reasons I'm leaning toward a worse bear market than most think, or the numbers even suggest right now, just because I was around during that 70s bear market. And there were analysts, I'm sure Peter knows this too, anybody who's around then, there was one analyst after another who was a perfectly reputable forecaster who ran their ship into the rocks trying to predict the bottom in that market. And it didn't come until December 74. And as predicted by A.J. Frost, the great Elliott waiver from Canada. And that was a 50% decline in the market. And when that market hit bottom, nobody was bullish, I could tell you that. I remember seeing a road sign in December of 74, and it read "Survive in 75." That was right here in the metropolitan area. So now here's the big story. And again, this is one of the foundation graphs. This is one that Richard Mogi and I always focused on quite a bit. Now, I just remember this cycle. That cycle, I don't know where I was doing a presentation, but it turned up right here. I said, well, if you're up against the resistance, downtrending resistance line, the dollar's got to break through. When the dollar breaks through, you could turn that into a falling wedge, technically, or you could also say that the support level would not be challenged. So it was this cycle, which is dynamic, that enabled me to, or helped me predict a breakthrough. Then, of course, what we see here as big moves, looking at it daily, weekly, monthly, are not very big moves in this longer term view. And if I drew lines in here, which I actually should have done, that's a rectangle, and it broke out of the rectangle. And that counts up to like 110, the short term, and 120. And I see my friend Alistair McLeod over at Gold Money is looking at the same graph. He just made the same prediction. And so the bigger story is people are fleeing here for safety, and they perceive something coming down the pike that maybe most of us don't see right now. So what is that? Well, whatever it is, it it is quite bearish. And talking to people, I actually was in Manhattan, and I said, well, something about the difficulties on the southern border of the United States. And the person said, what difficulties? And I said, okay. Now, the business activity index, the BAI was developed by Ameritrust Bank, and they took any fragment they could get of economic activity, starting way back in, I think, 1780, and they pieced it together to make an oscillator, a histogram. And it folds out to about 20, 24 inches in length. And no matter where you went on Wall Street, you would see one of these tacked up on the wall. In 1988, the bank was taken over, and the first thing you do is you get rid, of course, of all the creative people who do these wonderful and valuable things, and you get rid of them all and replace them with bureaucrats. So I maintained the numbers because they updated it by feeding in the FRB index of industrial production, into a regression program. And I've been using that to update it since '88. And this is from an old, this is from the Hall of Fame, which is why it's so, it looks this way. This came from an old Daisy line printer, if you can remember those. That was back in the days of steam-powered computers for you younger viewers. But here you have the real estate bust, the stagnation, and the 2016 boom. That is the BAI index. That is the projection based on 6 cycles. The shortest was 12 years in length, and the longest was 36 or 38 years in length, with all sorts of cycles in between. The 12-year cycle is actually the strongest. But here, I was saying there's some sort of a top coming, and of course, I'm aware of the real estate cycle. And I knew that the land in this, New York, New Jersey area, I was raised here, was not worth the prices it was selling at. And I knew what could cause a recession, but if the real estate prices fell, that cuts into everybody's disposable income. They will not take out second mortgages on their inflated houses. So that turned out to be true. And then I'm in London. I said, yes, that's a very interesting, young man. So one of these very distinguished gentlemen with white hair and a mustache, who's a walking history book on economics and European history. Why should there be a period of stagnation? And thinking on my feet, I said, well, they'll probably bring in an administration that's not friendly to business, is the way that I put it, politely. And I said, that will not end until 2016. So 2016, I just said, of course, nobody had heard of the last president. He wasn't in politics, he was in business. And we certainly knew who he was. But I said, I imagine a very friendly Reagan-like figure will come in and set off a boom, also realizing that the acceleration in the real estate cycle would occur at that time. And I can't see business activity picking up and real estate picking up without the whole stock market picking up and without everybody making a lot of money. So that was the cycle composite in 2021. This program, by the way, if I could get it working, it's a DOS program, I would do it in that format, but I couldn't. So that's what it looked like in 2021. And here is 2022. Now, curiously, this shows a low in Q1, which I didn't really, I thought, well, maybe that could be a bounce back from us taking the masks off and the COVID restrictions. And I haven't shown the other years here, but this goes back up. Then it comes down again into 2023. And then out a little further, 2024, 2026, you get a really a bad decline in this. And I was talking to my who's Switzerland's best known fund manager. He used to come to my villa in Abu Dhabi. I can't think of his name. But one of the most successful fund managers. And he also was specializing in technology. Anyway, he thinks a bigger crisis, thinks they're going to inflate their way out of the current crisis, and a bigger crisis is coming down the road. So that is the way it looks to me. And at the moment, in terms of trading, I have a long bond position and a small long stocks position. And outside of that, I don't have much of anything because it's just number one, very volatile. And number two, I don't see any really sustained trends except the one to the downside, which I've seen since December. But right now, with the 1-4 10-year cycle turning up, I'm a little, I closed out the inverse positions, the short positions, because that cycle turned up. Now the market is at least hesitating. And if you look at the numbers, the last week, I think they're less worse than they were. If you look at the new lows keep expanding, but they're expanding at a lesser rate. So if you deduct new lows from new highs, it's sort of a flat line. So the S&P is going down. There's a flat line in new highs, new lows. So it looks like at least a bullish divergence that should get us some sort of a rally. But I'll stick with the prediction of a very weak September into October, and then of a rally into the fourth quarter of next year and possibly up into the Q1 of next year. So Ron, if anybody has any questions.
Yes, I was just collating them right now. Fantastic presentation, Bill, as always. It's walk down, well, historical street, I should say, in terms of the different cycle insights, but also what they all mean here and now. First question, Bill, if we could walk back to your cycle framework, the 10, 4, and 1, and just quickly recap what they are all projecting here and now.
Okay, well, let me just go back and say, just for orientation, that the red is the annual cycle of the year, the decennial 10-year pattern is the blue line, and election year cycle is the 4-year line. And in Q2, they all declined simultaneously. And right now, you've got an upturn. You can see the summation down here. You've got an upturn, July, August, into late August, and then a downturn. And that is being caused by upturns in the 4-year cycle and the 1-year cycle. The decennial pattern is declining, but at least here it's relatively flat. Then it slumps off along with the annual cycle in September, but then all of them rise. And you can see the summation down here. And that's the 1-4 10-year cycle blown up with its components. And here's the 1-4 10-year cycle in Q3, and here it is in Q4. And let me just
and on that point, please, Bill, continue.
Yeah, 60% of all profits in the S&P 500 had been made in Q4, historically.
The additional question to that, Bill, was the midterm election. So clearly a hot topic. How does that influence the cycles you just showed?
Well, I don't let it, I just do the cycle straight. And when I put it all together, I used to like to sit down with Ian Notley at Notley Information Service and say, what does this describe to you? And a good example, the 70s. Well, how could the economy get weak and inflation continue to go up? Answer to the question is because the inflation is being caused by the central bank, not by lack of demand. So I'm looking at this saying that there will probably be some developments in the midterm election that will bring a cause for cheer to some people, and that we may be returning to a more business-friendly environment. I'm not going to bet on that. I'm just following. I do the cycles, then I let the technicals confirm what the cycles are telling me. And at the moment, I can tell you, I'm looking out on New Jersey here outside of Princeton, and there's nobody out there who supports the current administration or what they see happening.
And then a follow-up more on the sector basis, growth and tech, early chart that you shared, but underperformance to continue. Do you see a top in place? And if so, how much lower?
Is that how much lower in the overall S&P 500?
Well, technologies, well, both the S&P 500, but specifically
3,300, 3,400 on 3,300, 3,400 on the S&P, which is that double retracement level of 61.8 and 38.2. And on technology, I follow that sort of on a week-by-week basis, because if you look at the numbers, they're generating just some phenomenal study. The technology, the major technology companies have some fantastic share of American profits. They are making the money. It's just a question of the stocks have become very, very, it's not a question of the money they're making. They just became too overbought and had to pull back. And so the earliest I would look for, there was a natural tendency for technology seasonally to top in mid-October and bottom, to top in mid-August and bottom in mid-October. And in order to counter that, I used to cut profits we had made in the big technology stocks and buy automatic data processing and paychecks, which are in technology, even though they're just info processing stocks with PE ratios of 10. And when called and asked by the people who are wiser than me, who don't manage any money, as to why I was doing this, they wanted to know what the fundamentals were. And I said, well, do you want to sit through a sharp technology correction from mid-August to mid-October? I'm sitting in the seat that I have to answer the questions. That's why I'm doing it. I'm doing it to protect the profits. And later on, I was to find out that automatic data processing, information processing, paychecks, they have a seasonal cycle that is strong from August through October. So I guess other fund managers saw that and they were doing the same thing I was doing, which creates the seasonality.
Great. And there was a few questions on the reference to the 1970 bear market analog. So one part is what characteristics in particular kind of stand out to you in terms of, is it market regime? Is it the macro environment?
Well, it's a number of things. Inflation at the CPI level, number one. And number two, we have a Democratic administration that is not friendly to business.
And in terms, in price terms, we have a question from, I think it was Mark. Does that mirror your view for the next decade? So 70s had a 16-year bear market with elevated vol. Is that what you see in the future, or a variation of that?
A variation of what? I'm sorry, Ron, could you repeat that?
A long-term sideways bear with those roller coaster price swings that we saw in the 70s?
I think so. I think, probably, you see, the problem with a lot of this is inflation. How do you factor in inflation? Richard Nixon took us off the gold standard in 71, but in June of 1980, Jimmy Carter signed the Monetary Control Act, which says that the Fed can monetize anything, including all of our American Express accounts. They can buy them from us and give us cash and hold that on their balance sheets. There's no limit to that, which means they can inflate into infinity, which means, as Ian Notley used to say, he used to call it a successful reinflation. He would say that people forget how badly they've been burnt. They put tremendous amounts of credit out. People start buying again. And I don't know how to factor that in. And in fact, I sat once in Princeton Economics, only about 10 miles from here, with Marty Armstrong, and we were trying to figure this out. He was saying, the inflation distorts. What do? You divide everything by the price of gold? And it's kind of hard to know. But I think gargantuan amounts of inflation are coming yet. And at some point, this market will experience a very good rally, but I suspect it'll be a rally of poor quality. Remember this story I told about the poor earnings quality caused by inflation at the CPI level. I think we're going to have a big rally, but I think we're more in a period that followed like 66 to 82.
Interesting point. And I noticed that there was, various views that are being shared out about the nature of a bear market rally in a big bear. And I think it was Michael Burry that tweeted about this recently in terms of his comparison to 2029. The minimum is 10%, but the average is about 23%. What can you share in your experience, Bill, about bear market rallies, their characteristics, but also the ones that we might experience this year or later?
Well, as Richard Russell used to write, trying to catch bear market rallies is the single most difficult thing you can do. And they can be anywhere, 10%, 15%, they come out of nowhere. If you make any money, you should take your profits pretty quickly. I still think, we're very much on the downside. And if we're going to see such a rally, it'll be in Q4.
Okay. And then the reference to leadership in emerging markets, Asia and China in particular, that was a great chart just showing that China bottomed in April and I think now nearing its 200-day average. How robust do you think some of those markets will be in a potential shakeout? Do you think they'll be relative outperformers and then in time lead us out or something else?
Ron, I think they're relative outperformers. That's how I would put it.
Okay, great. And then a question on gold. I think it was a two-stage cycle, kind of a short-term up for the next month or two, and but then the dominant cycle pressuring down. Is that a fair read?
I'm looking for a rally beginning in the last week of this month, up through August and September. And then historically, gold usually declines in the second half of October. And again, I have no idea why these things occur. And then you get a relatively strong November and December. I think there has been significant competition with real estate and Bitcoin. Money is going there as an inflation hedge. But I think, the wheels have come off. And, I sent out to John Bollinger's mailing list and to my clients a graph of Bitcoin declining and that old Adam Smith quote, "All money is a matter of belief." And I think the wheels are coming off. People are waking up to this. There's no intrinsic value. Or as I saw somebody probably woke up in the Netherlands and said, what am I going to do with all these tulip bulbs?
And just in the time that you have, Bill, final questions on real estate. And this one is from James. Real estate cycle 18.6, 91, low 2010, next low 2028, 9 top. I think we're going through kind of like the projections here, and the question is basically where would your top projection be? So I think you mentioned next year as being an interim pressure point.
Well, 2023 is the peak in the cycle, but I already see, as with any market, as you start approaching a top, you start to see divergences, you start to see things that don't make sense for the bulls, and that's what I'm seeing here.
Okay.
Housing's less affordable. It's harder to buy something. They're becoming more cautious. They want to see the house completed before they put in the bid, things like that.
And then James is asking about your view on 30-year bonds to move as strongly as 10-year bonds in the next few months, or would you differentiate between the two?
Between the 10-year and
30-year.
I think the 10 is going to move more. Yeah, that's a good question. Yeah, I've been watching that. I think the 10 will accelerate more than the 30. Yeah, just one other point I wanted to make about Bitcoin, that one of the biggest backers of Bitcoin was the late Matthew Mellon, and I met with him before he passed away about 3 or 4 times in New York. And he said, I'm getting tired of this. I'm thinking of backing away from it. I said, why? And he said, well, the coders are a pain to deal with. I said, they usually are. And but the government wants to create a gov coin or a government coin, a G coin, and they're talking to me about that. And that's what I was waiting to come along. Because whenever the government comes in, they're usually not friendly to free enterprise. So my feeling is that'll be like a tidal wave that will drown all of these little cryptocurrencies. But the big ones will still be there. But I'm still not sure that they're at a price at which I want to buy them. That hasn't even occurred yet. And this reminds me of periods when, like I think it was after the Civil War, when you could open up a bank and issue your own currency. And some of the, if you read the history of banking in America, some of those banks are still around today because they follow sound banking principles. Most of them are gone. So that's the way I look at cryptocurrencies. I think we're having a good shakeout right now. And I'm waiting for the government. I mean, the current administration has already expressed an interest, but I don't know what they're doing. Because ideally, they can track everybody's transactions that way pretty easily.
And a final question from a Gulf participant about those markets. What are your views?
Well, as I said, I think Abu Dhabi's got one more rally up into the summer, into August or September, and then it's going to come down. I lived there from 1990 to 2003, and I make trips down there, and I talk to people there every Monday. And those markets are pretty thin. They can go, if you look at the history of the Kuwaiti market, it can go way up and then it can crash. And so if I get any profits, I would take them and move away, because I think if you look at the best, I don't have it in front of me, but the best performers are all these tiny, it's Nigeria, Copenhagen, it's little markets, Tunisia. And I think there's just so much money. It's like the Michael Jordan, the ticket to the Michael Jordan game of the comic book. The money's got to go somewhere. So it's going somewhere with low P ratios, with flat chart patterns, and it rallies up. And I think as soon as some more attractive alternative comes along, they'll go back down again. Probably.
Thank you very much. Thank you very much, Bill, for a great presentation and for extending for the questions.
Well, thank you, everyone. Thank you for your invitation, and thank you, everyone, for attending today. I'm going to have to run, so.
Thank you very much, Bill.
Adios.
And that's a 3-day marathon run from the Foundation Study Cycles with 6 leading speakers sharing their market insights for the second half of this year. Continue to follow us on cycles.org. This is Ron William, Development Director on behalf of the FSC. Look forward to staying in touch with you all. Thank you very much. Bye-bye.